Planning for retirement can feel daunting, and deciding what to invest in, how much risk you should take to achieve your goals, and what generally fits your investing timeline can be overwhelming. Well, did you know that there are funds called target dated funds, which are set it and forget it investments that are designed to adjust over time? A target dated fund is a fund tailored to a specific future date, usually the year of your retirement. It starts off aggressively in stocks for growth, then gradually shifts to bonds and lower risk assets as retirement gets nearer. For the investor, there's no guessing or constant portfolio rebalancing, as the fund does all of that for you. Bonds are essentially loans that you give to governments or companies in exchange for regular interest payments. Unlike stocks, bonds are less volatile, meaning that they help to protect your money as you get closer to retirement. Some of the key benefits of bonds in target date funds are stability, as bonds provide predicted returns for reduced risk, income generation, where you receive regular interest payments, and capital preservation, as bonds can help safeguard your savings from market downturns. And another benefit of a fund that increases exposure to bonds is negative correlation. In investing terms, this means that the price of two assets moves in opposite directions. And this relationship is particularly important when looking at the relationship between stocks and bonds. Historically, stocks and bonds have shown negative correlation because during economic growth, stocks tend to perform well as companies generate higher profits. But during economic downturns, investors seek safer assets, increasing demand for bonds, which raises their prices. This means that when stock markets decline, bond prices often rise, helping to offset losses in your portfolio. So a portfolio with both stocks and bonds can help reduce volatility, with bonds acting as a stabilizer when stocks experience downturns. It can improve risk-adjusted returns. The combination of both helps balance risk and reward, and it can provide diversification. Different assets respond differently to market conditions, reducing overall risk. The gradual transition over time from stocks to bonds is called a glide path. Imagine you're flying at high altitude. This represents the early years of investing, where you're taking more risk with stocks to maximize growth. As you approach your destination, retirement, the plane gradually descends, reducing speed and adjusting to a smooth landing. Just like how a glide path shifts investments from high-risk investments in stocks to safer ones in bonds and cash. And this is a well-established strategy that most UK workplace pension providers use to gradually adjust investments based on your retirement age and how close you are to retirement. Target date glide paths formed on well-established wisdom. Many people can afford to take on higher risk in search of growth when they are younger, or with many years remaining before they reach their objective. Conversely, older investors, or those near their target, should increasingly focus on wealth preservation, prioritizing this above growth. And this risk management technique reduces the chances of a big setback, and thus protects the wealth that you've built when you need to rely on it in retirement. And here's a simplified example of how a classic glide path looks. The orange shaded area represents the equities allocation that declines as the target date approaches. The remainder of the allocation, depicted in green, shows how less risky assets, such as bonds and cash, increase to replace equities as the end date closes in. The downside of these safer assets is typically lower growth than stocks, but they earn their keep by lowering portfolio volatility and being more likely to hold their value during economic turbulence. The older you get, the more important that becomes. In 2023, global asset manager BlackRock launched 9 target-dated funds in a UCITS mutual fund wrapper called BlackRock LifePath Time Date Funds that allowed more UK individual investors to save and invest for retirement within a self-invested pension pot or SIP. Vanguard also have their own version of target-dated funds called Target Retirement Funds. Although each provider's funds consist of different investments, they are constructed similarly, where they are a big fund made up of a combination of other ETFs and index funds, providing access to a diverse range of investments. In both cases, the funds are active, in that investment selection and rebalancing is automatically handled for you. You do not have to get involved, which is the joy of a target-dated fund. The year that the target-dated fund completes its glide path is featured in his name. If you like the overall product offering, then you simply pick the iteration which most closely corresponds with the year that you plan to reach your objective. To take a real example, if you'd like to retire in 2040 and Vanguard funds are your preference, then you'd pick the Target Retirement 2040 fund. However, if you cannot match a fund's year exactly with your retirement plans, it is okay to have a 2 to 3 year gap between your intended date and the fund's headline target date. Investing is not an exact science, so there's no need to align precisely to the year quoted in the product name. Remember too that it's the year that you plan to complete your goal that counts, not the goal itself. Regardless of the amount and the objective at stake, the purpose of a target dated fund is to reduce downside risk as your deadline approaches. Target date funds may operate smoothly on autopilot, but you might still need to keep an eye on them. There are no guarantees with investing, and no guarantee that you'll reach your investment goal by a specific time. Just because they adjust to safer assets as you approach retirement does not mean that these investments are immune to market shocks. For example, stocks and bonds could sometimes fall together, as both assets are vulnerable to fast rising inflation, as what happened in 2022. So while you can happily leave your target dated fund alone for a while, maybe a year or two, you should still check in from time to time. And as a minimum, you should adjust your investment cash to keep in line with inflation and the cost of living to maintain the purchasing power of those contributions. And if you're unlucky enough to experience a poor run of returns, you may have to invest a little bit longer to reach your objectives if you're worried about falling short. Finally, use an achievable rate of return, key to your target date fund allocation when calculating how long it will take to reach your number. This target will depend on your contributions, the amount of time you invest, and your overall return. The first two numbers are within your circle of control, but future returns are inherently unpredictable. Before making your decision on whether target date funds are right for you, weigh up the pros and cons. The potentially good things about target date funds are simplicity, one investment does it all, asset allocation, diversification, and risk management. They offer hands-off investing, as the fund automatically adjusts as your goal gets nearer. There's no need to trade or rethink allocations yourself. They offer behavioural benefits. By taking decision-making out of your hands, target date funds can reduce the temptation to time the market or panic sell during downturns. And they generally come with low cost, typically providing battle-tested investment strategies for a competitive fee. But the not-so-good things about target date funds might be that they're not personalised. The glide path is based on the typical investor. Your circumstances might be different. You might have a higher or lower risk tolerance, for example. The glide path is one-size-fits-all. Products may de-risk too quickly or too slowly for your preference. You may end up being too conservative or too exposed to risk, near your goal relative to your personal preference. This often happens with workplace pensions, where the pension providers put you on a path that might consist of too many safe assets when it's too early in your investment journey for your liking, and where you might then miss out on growth opportunities. You also need to be aware of the cost gap. While target date mutual funds are low cost, Vanguard's range comes with a 0.24% TER or OCF. Mutual funds are more limited and expensive than ETFs, and are generally only available on investment platforms that charge a fee. For example, Vanguard charges a 0.15% custody fee that has a £375 per year cap, in addition to a £4 monthly fee if you have less than £32,000 across all the accounts you hold with them. So this could be a little expensive if you're first starting out, especially if you do have the confidence to manage your own stocks and bonds ETF portfolio for a lower TER on investment platforms that don't charge custody fees for holding ETFs, such as Trading 212 and Invest Engine. Target date funds can also be more problematic to adjust in mid-journey, as you can't easily tweak that asset mix. If your plans change, you may need to sell that fund and reinvest elsewhere. Overall, target date funds could be right for you if you have a clear time horizon, you want automatic risk adjustment over time, and you prefer to outsource your investment decisions. But target date funds are not perfect, not least because there is little choice for UK investors at present and no cheaper ETF version. Moreover, if you want to adjust your strategy, add different assets, or if you have an unpredictable investment timeline, then a DIY approach might suit you better. But ultimately, target date funds are a powerful tool. And like all tools, they work best when they match the right job. If you are a US investor, then since 2023, you have had access to the iShares Life Plan range of ETFs. And if outside the UK and in Europe, Amundi announced their life cycle range of 4 ETFs for European investors in 2025 with low TERs. Hopefully, these plans will also arrive in the UK soon. So what's your retirement year? Let me know in the comments. And please don't forget to like the video if you enjoyed it. Consider subscribing to my channel and to turn on notifications so you can be aware of when I post new content. Thanks very much for watching.